Hello. Hello, is everyone can hear my voice? If you can hear my voice, can you give me, can you type 666 in the chat box so I know that every one of you can hear me? Okay, great. Let me see who has already in the zone. Okay, we have Alex, Anna, Charlie. Long time no see, Charlie. Chong Chong. Wow. Seeker. Eric, Joseph, and many more. We have about 100 sign out today. So a lot of times, right, there is a huge sign up, but the attendance sometimes because of the work schedule, meeting, this and that, right? Some of the people might not be able to come on time, but we should not delay further. Let me say good afternoon to everyone. Thank you for joining the Zoom webinar this afternoon. I'm Len, I'm from MAL. It's my great pleasure to be your MC this afternoon. Today, the live sharing will be running on Zoom. So for those people that did not manage to sign in on time, you can actually go to the live video through MAL Academy Facebook page. However, the one-to-one question time with our keynote speaker, Mr. Song, right, will only be open for those in Zoom. And let's do a bit of the administrative. For those that come in, right, can you please help to mute your mic and on your video so that later on, right, we will have a very good interactions with our keynote speaker today. And you can actually ask the questions that either concern you, your family, or your business. So we will open out the Q&A sections at the end of the presentation and in between of the sections also. So today, right, our topics is 2021 Regional Economics Outlook, Risk and Opportunity. So from the title itself, we know that we are covering about not only Singapore, but also global and also the world economics outlook. And then we also want to identify, right, is there any risk and opportunities that is we did not know and we want to be prepared earlier. So as far as we are concerned, we hope and we think that the worst is over, right? Because I think if you follow the recent news, the vaccines is outcoming, and then Singapore is open out to phase 3 now, and we look for a better year of 2021. However, there is another school of thought, right? And there is a lot of news in the market also that there is a hidden landmine has yet to come and yet to be unveiled. So is this news true? And if it is, what is it and where is it? So let's not have a guessing game, and more importantly, right, to keep ourselves informed and be ready for what may and could happen next. Correct? So first of all, right, let's recall the history. Okay, why I cover this is because, right, if we look at the history, right, we know that 1997 is Asia financial crisis. And after 10 years, right, in 2008 and 2009 is actually the global financial crisis. And we step into 2019 and 2020, which is the COVID-19 that is the recent news. So the question is, right, is this COVID-19 is considered as economy and world crisis, and is it over already? Because if you look at the world economy itself, we notice that there is a lot of what is that called, besides the disease itself, right? The economy is actually have a sharp drop in April 2020, and the market actually consider not really collapse, but actually have a sharp drop, and then it actually recover pretty fast after April 2020. So our question is, if this worst is considered over already, because now market have plenty of money, right? Whether property market or the stock market have plenty of money. And why is it happen? Because economy is supposed to be on the downward trend in 2020 or 2019 to 2020. So is this a false symptom that the market is actually in a process of recovery? or is it that it is actually on the process of recovery? So in the layman term, what is the QE impact? The QE means, like for example, US, Federal Reserve, Europe, Japan, right, all printing money and they are pumping money into the market. So is it effect, right? We call it musical chair. Is it going to collapse one day? So is it the time out already? Because it's 10 years, so-called the 10 years decade already, right? One decade already. So every decade, it seems that there is a big corrections in the market. So today, right, the topics is invariable because it's going to preempt you something that is going to happen, and it's going to preempt you some opportunity that you might want to grab. So we are recovering, right, from the global issues, which is on the world issue, and local specific issue like Singapore and our neighboring country, Malaysia, and also specific assets issue. And we will also take questions from the audience, participants like you, from time to time, as and when, as well as at the end of the presentations. Thus, if you have any question about yourself or your business, do feel free to type it out in the comment box. Okay, the comment box is under the chat box. So for those that in the Zoom, right, you can actually click the link provided in the chat box. Have the link actually provided? Our colleagues here, can you please provide the link in the chat box, right? So once you click the link, it will actually bring you to FB. You can actually click the share button in the right corner of the video to all your profile friends and group you join. And for those that are already in the Facebook, right, you can actually just click on the share button or hashtag in the Facebook comment section to invite your friends to join. Because the more you join, right, the more you share, the more friends that will be benefited from the sorry. So can you hear me now? Okay, good. Panda, is it? Chong Chong. Hi, Chong Chong. Thanks for joining us. So, okay, let's start our live section today, right? But before we start, right, because just a bit more about our platform is we are a bona fide FOC for public service platform. So we actually conduct online or offline courses, online or offline sharing. So before we start, right, we would like to do a disclaimer because this topic is going to cover probably on some investment class of assets also, and some decision you might actually make or some plan that you might change after today's sections. So MAL events are for education purpose and should not be constructed as an advice. So MAL is office holders, associates, sponsors are not benefited from your profit, neither we should be held liable for your losses. So speaker opinion, right, are his or her opinion and does not represent us. So speaker opinion might be used as reference and should not be formed as an advice. So if you have any doubt, do seek for professional advice. And last but not least, enjoy learning. So okay, now let's me have a chat, right? Is anyone Mr. Song Seng Wun friends or fans? Do type 222 in the comment box. Let me see how many of Mr. Song friends here. Come, any Mr. Song friends here? If you are Mr. Song fans or friends, do type 222. Okay, good. There are a few of you, right? Because I think our platform is more for Chinese audience and Chinese business owner. So Mr. Song a well-known speaker, and today we are very great. We have a very great honor to have our keynote speaker, Mr. Song, who is a director of CIMB Private Banking. So let me have a big background about Mr. Song, if you have yet to know who is this big person. Mr. Song holds a Master of Arts in Economics from University of Canterbury, New Zealand. He started his career as an economist in Malaya Banking Berhad in Kuala Lumpur. He moved to Singapore in 1990 and worked as a regional economist with various major multiple national financial institutions such as Merrill Lynch, Woodward, as well as ABM and Bro. With over 3 decades of working experiences, covering 3 regional and global recessions. I think is 20. So he actually covered Asian financial crisis, global financial crisis, and the recent COVID-19, right, Mr. Song? So Mr. Song's areas of focus are in the economics of ASEAN 5. He is also a family icon in Southeast Asia new media as he has greatly contributed his professional views on the regional financial market such as BBC, CCTV, CNBC, CNN, and many more. Let's have our warm welcome to Mr. Song Seng Wun. Mr. Song, please. Mr. Song, please.
Hello. Can you hear me well, loud and clear? I hope
hi,
so.
Hi, Mr. Song. Good afternoon to you.
Hi. Thanks for the nice introduction, and I'm basically just a K-baller. And thanks for arrow me to work on year end. Typically, I think all of us will be holidaying somewhere already, either in Kampong or here or there. I mean, this is, I suppose, what it is, this pandemic year, in that whether it's Chinese New Year, whether it is coming Chinese New Year, or whether it was Hari Raya or etc., we certainly have seen all our plans disrupted. I suppose to a certain degree, we can look at it in terms of how Singapore has been affected. We are talking about year-end, and normally year-end will be somewhere. Last December, we're talking about 2019, I think roughly around 1 million residents would depart for holiday here and there and everywhere. And roughly around 1.7 million tourists came, last December, 1.72 million tourists came to Singapore to celebrate the festive holiday. Obviously, very few this year, either coming in or even leaving Singapore. That's how things have been. That's just, I suppose, a snapshot of how life has, I think, been significantly impacted. Business behavior, household, individual behavior has been this year. But before I talk about outlook and whether the behavior will improve, we certainly have seen much more rosier forecasts of how 2021 is likely to turn out. We hope they're all right, but obviously we have risks. But before we talk about next year, I want to look back. I think earlier, Lens, you highlighted one chart in terms of the past recession from the 98 one. I started work in 85. That was my first recession in KL. More localized recession. That's more, I would say, perhaps due to the oil shock in the mid-80s, and relatively mild, but it still has significant impact and repercussion around the ASEAN economy. If we want to take it further back, look at the short history of Singapore. We talk about modern history of Singapore. We have kind of a severe downturn or a recession every a decade or so, like every 10 years or so. If you want to roll all the way back to the mid-60s, confrontasi, Indonesia and Malaysia fighting over my kampong, Sarawak. I still remember growing up with British soldiers running around our little compound. 70s, oil shock as well. 80s, the second oil shock. 90s, ASEAN financial crisis. So every 10 years or so, we have this significant impact to sort of trigger the end of a growth cycle before we start on a new growth cycle. So that's the framework. Even before we had the pandemic, COVID-19, I think we were already entering 2019 on worries that the cycle, which I suppose started from 2008, the global financial crisis, were already fairly extended. Central banks around the world were already warning about downside risk. we had obviously flagged the worsening US-China relation as one of the risks that potentially could trigger a downturn. We had put a pandemic as one of the tail risks, especially after SARS. We put in pandemic there as one of the risks, never realizing seriously that it will become the base case for 2020. So it was, in that sense, a tiny little virus that triggered the recession of this year. But even before then, as I say, policy planner were already mindful and telling businesses, household, not to be overextended because of risk. For those that might recall, the MAS, the government were already tightening leverages, lending to household, etc., warning that we do not want household and business to be overextended because we could be facing a tail end of a very mature growth cycle. So the groundwork were already, in that sense, prepared. And so when the pandemic hit, which is why looking at today, we had not had such severe impact on businesses, household, because businesses and household were not over leveraged as we enter this recession or experience this recession. So that was the tail risk that became the base case. So if we look back over the last, I suppose, 8 or so months, we certainly have seen how brutal it has been, not just on our economy, which suffers was recession, but also regionally, globally, and even today, the pandemic still have impact beyond just the normal businesses, for instance. So as we head into 2021, much has been, I suppose, discussed about whether the vaccine, this is being rolled out, will help, I suppose, give everybody that trigger to start a new growth cycle. But this is not your ordinary recession in an ordinary response to start on a new growth cycle. In the past, we certainly say very straightforward: recession, cut interest rate, government step up spending because private sector businesses are more cautious about spending, and then we start on a new growth cycle. Here in Singapore, we would certainly be seeing construction contract being sort of awarded, or contracts or project being announced, being brought forward, and the cycle of pump priming the economy starts. Not quite this time, this year. Again, as I say today, we're still talking about travel restriction. Many countries are reimposing restriction or lockdown because of new surges in cases, even as we roll out vaccine and treatment hopes, supporting optimism. So this is where we are, in a sense, facing 21 with optimism, but yet at the same time.
Sorry, Mr. Song?
Sorry, I'll take a break.
Audience, can you please mute your mic so that we don't have the interruptions with the audience, other audience? Thank you. Okay. Okay, Mr. Song, you can continue.
Okay, there's a slight break. Okay, now back to where we were talking about in terms of optimism, and in sense, certainly there's room for optimism. Everything that you see at the moment in macro data, which is why I didn't bother with charts, in that you have growth from 1Q, you have a collapse in economic activities in Q2, with the exception in China, where collapse in Q1 and then Q2 rebound. So we have that V-shaped rebound in Q3. For Q4, it will be very interesting because for some countries, we are talking about cases like the UK or perhaps even Korea, the cases and the reinfection has led to restriction and lockdown. We could see a pullback in activities. We could see a double dip as far as the growth profile is concerned before vaccine treatment hopefully comes in and kick in and the infection is contained and recovery in that sense show up more pronouncedly, perhaps in the second quarter onward. So this is just an example of how I suppose the outlook in terms of just hard GDP figures could turn out. Some will be, in that sense, a square root sign. Some will be in terms of more straightforward recovery, as we've seen, let's say, from the Chinese side, or for many others, it could be V-shaped and then wobbly and going forward. And that's just at the headline basis, because below that, we certainly have and will see the impact on the many industries and sectors still being felt. We don't have to look too far, except here in Singapore. We can't go anywhere. There are not that many people coming in. Visitors, as I said, typically we used to welcome last year in 2019, 1.6 million tourists every month. Latest this, I think October, November, we can count them, thousands of them, and they are not really tourists. They are here for various reasons, either for family, for business, as far as Green Lane, business travel are concerned, or treatment, hospital treatment, etc. They're just in the thousands. So clearly, for these industries in aviation, travel, leisure, we know them, they're still going to be facing significant headwind towards recovery, even if we were to have vaccine treatment and treatment being rolled out. But elsewhere, if we look around Singapore, we suddenly say, oh, luckily we are moved into phase 3 and with restriction being eased. That will certainly help some of the domestic-oriented industry, whether it is, I suppose, F&B side or some of the more service-oriented side, to, in that sense, get back on the more stable road to recovery. So we have many layers of recovery trajectory. It's really a case of some being still very strong. Obviously, we know where some of the more stronger growth are. I think if I want to take a little break here, the one thing which certainly has helped us through this pandemic period, unlike previous downturn and recession, is that it coincides with the technological innovation, engineering, digitalization that's being rolled out around the region. Prior to the pandemic, we certainly have seen, let's say if you look back at the last 3 budgets, there will always be a carrot and stick approach to encourage business to digitize, cloud solutions, but it's always very slow. This year, I think everybody bo pian, me too. So that obviously led to more business opportunity for those engaged in the ICT, digitalization, the whole space where technology and technological innovation has allowed new businesses to come through and ride on the behavioral changes as a result of the pandemic, as a result of you and I having to work from home, you and I still in an office in a December holiday, or even going forward, even for those going back to the office, we are still not going to see the same kind of return to pre-crisis kind of a business behavior or even consumer behavior. So this is where I suppose some of the opportunities still continue to lie. And obviously, behavioral shift coincide with several other underlying circular, maybe even structural change in terms of green energy, in terms of the businesses that have been, in that sense, generated by more focus and interest in sustainable sort of business development, whether it is in the F&B side food, whether you're talking about plant-based food or cell-based food. I think starting in January, we can have cell-based fried chicken for those who don't want to see real chicken being slaughtered. So all these are creating opportunities at this point. So where do we stand today in terms of the outlook? There is certainly much, and I think hope that next year will be better. I don't want to give any number. Very simply, it is here in Asia or Singapore. This year, the economy probably contracted between 6 to 6.5%. Next year, perhaps growth of 6 to 6.5%. But you guys know numbers very well. When you contract 6% and you rebound 6%, you haven't gone back to where you have fallen from. for Singapore, it probably will be only at best the end of the year, more likely the beginning of the following year, that we get back to pre-crisis GDP, i.e. Q4 2019 GDP. So that still basically means that we continue to still see businesses, many businesses still having to slog through next year, which essentially means that for government policy support, although we are on more stable footing now, obviously we still see risks out there. We obviously still see risks either coming from a new infection or just risk from businesses still looking at how to keep costs under control because their sales side isn't coming through. I still have friends, I'm just going to call a couple of them. They're salespeople in one of the large tech company. There's no sales, so they're being let go. So even as we speak, businesses, although many are hiring because there are various schemes to encourage them to do so, and many schemes still supporting, containing and supporting businesses, many are also still trimming as well. So yes, the labor market condition has stabilized because of the huge amount of measures that have been rolled out and quite an extensive one, but yet consolidation still likely to see labor market condition soften in the coming quarter, but not to the same scale as what we saw obviously in the middle of the year and 3Q, but there's still pressure on the labor market. Labor market condition can only improve if businesses, if business owners like you say, okay, I'm confident enough about my order flow and see visibility in my order flow that I start to add on to my payroll or invest in expanding my office or premises. And that's when we see, as for sustainable recovery, taking root to broaden the recovery. Is it happening just yet? Not quite, but at least we are selectively seeing so. I think one of the numbers that I see so far this year is, even though we have the worst recession in our short history, in that the number of business failure is still relatively mild. It is higher in terms of compared to prior years, but in terms of business formation net numbers, it is still amazingly strong. Primarily because we have a couple of things happening, which is behavioral changes allow new businesses to be set up to take advantage of them, whether you are in manufacturing, whether you're delivering services, whether in the ICT side, or whether it is in terms of, say, health tech, just consultancy, a virtual one, for instance, as well. So this is one of the biggest difference, this recession that is obviously has made a difference this time around compared to, say, the previous 4 or 5, let's say roll it back, 5 recession, which has allowed us to support the business opportunities that continue to be rolled through going forward. Okay.
Being said that, right, Mr. Song, so to summarize what you had said just now, right, you're looking at it says that the 2021, right, it probably is a recovery year, bearing that because vaccines is coming, the worst seems to be over.
The question is the quality of that thing.
Yeah. So, but we also have another huge concerns, right? There is debt default cases of listed company. There's a breaches, and there's a number of B2 high ranking banks, especially China banks now, right? They actually suffer huge losses. Like for example, ICBC, Ping An, Construction Bank, China Merchant Banks, all suffer losses. And worse still, right? There is a B2, the Baoshan Yinhang, right? It's even they have bankrupt in 2020. So with all these China banks and the world strong banks, they're actually not doing that well. Will that actually implicate Singapore banks and the so-called the default rates will actually go up?
Good question. In any recession, there will be business failure. It is inevitable. It has to happen. We have to clean out. But again, as I say, I suppose the good thing at this moment is, even before the pandemic, we certainly have seen not just Singapore Central Bank, but the Chinese Central Bank and Chinese policymaker taking actions on many of the Chinese companies. Remember, a couple of them were very, very aggressively accumulating and buying companies outside of China on debt. And they certainly pull them back. And if not for the earlier actions taken then, I would certainly have said that the situation in China would have been far worse in terms of a handful of these large private companies accumulating so much debt on acquisition trail overseas, which have certainly triggered a much more serious concern about systemic risk within China. They have taken action, but obviously not to the same extent that they would have liked to, because if they over-tighten, it certainly could implode. But taking a more controlled approach in terms of allowing some business to fail, there were not many of them couldn't service their sort of bond payment due up. Allowing to fail just, I think, reinforced the message that they are moving on to a more business-driven commercial business decision based on, in a sense, profit and losses, rather than a case of, we are a state-owned enterprise and we will always be there irregardless of how we perform. I think those kind of perception or belief is now, I would say, out the window. But what does that mean for today in terms of the failures to come through? There will be still more failures, I would say, but I would say the systemic risk, I think, is going to be controlled. I'm not that worried about a wall of collapse coming through. It reminds me of how when you have things being centrally controlled, you certainly will see things being, in a sense, controlled default, shall we say, because you need things to be clear out. You need businesses to fail to allow new ones to come through. Will this lead to a wholesale default of the banking system? I say no, because the Chinese central bank and policymakers had already, I think, been wary of a recession coming. Central bank around the world, I think, has been on alert over the last 3 years on what could trigger a recession, and has taken measures to, in that sense, deleverage, which is why, when they had that boom still in the property side, they continued to apply the brake. But obviously, the simple answer now is, will there be still failure going forward? Yes, but it will still be at a controlled pace, I would say. NPL will go up, but when NPL go up in an environment where there's still growth, and China's growth is still, I think, fairly stable now, not quite back to pre-crisis level, but good enough to generate employment and business opportunity, while it allows many, and we're talking about many businesses that will fail. So it is a necessary step to go through in terms of readjustment to a new growth cycle.
Yes, precisely. So because we also know that MS actually pretty cautious, and before many months ago, right, he already announced and then alert all the Singapore banks, right, to actually control and do not actually distribute all their so-called distributable income. Correct. Stop the dividends or cut down the dividends payout. So they could be one of the major alerts that our central bank has been doing.
Indeed.
But you see, Singapore, we are such an open economy, and we are not that big in that sense, as in terms of the world economy. So other places, other countries, right, like US, especially US, China, Europe, and Germany, all these countries, Euro countries, right, their economy policies and their financial situation is actually a huge concern to us as a small country like Singapore. So especially the QE, maybe can you explain to the audience? I'm not too sure how financial savvy our audience is. Probably you can explain what exactly is QE and how is it impact, and can it be a hidden landmine to the market?
Okay, all right. Okay, in terms of, as I say, as far as this crisis is concerned, I would say most central banks, in fact, I would say almost all central banks around the world has been on watch over the last 3 years because, again, as I say, we were all cautious about the impact of what could possibly come after a long mature growth cycle. So there have been doing, remember after the, for us in Asia, Asian financial crisis, we learned our lesson from there, and we essentially has been instigating more check and balances on banks. And for European and the North American bank, the global financial crisis obviously was the trigger for them. So since then, we certainly have much more rigorous annual, quarterly stress tests for banks, even in China, even more likely in a sense type. So from the central bank perspective, we are less concerned and more, in that sense, confident about banking system being more robust, not likely to face, in that sense, systemic risk from a rise in non-performing loans because we had factored them in. Now, that's monetary policy. Very simply is to, in that sense, to help economy through a crisis or when the economy is experiencing very strong growth, we have two sides or two brakes to apply. One is a central bank monetary policy. This is interest rate, cost of borrowing. If things are very soft, economic condition very weak, you cut interest rate, you make money available. Now, on the flip side, as I started earlier on, is the fiscal policy. So these are the twin engine that policymaker can apply to either lift growth or to put a brake on. Fiscal policy, government, in terms of taxes, in terms of spending from the government side. For a small open economy like Singapore here, when we have downturn, the Singapore government just step up. Private sector not spending, we spend. We hire, we bring forward projects to pump prime the economy. Now, not all government, in fact, no government around is ever like Singapore. We don't issue that paper. So in a sense, what is QE? QE is just a fancy word for borrowing. It's just like if I'm the government, the government of Song, the Song dynasty from my own individual province, and people believe in me. Hey, Song dynasty, not bad lah. At the moment they got cash flow problem, but never mind. Song, you issue that paper, we buy. Because I know you'll turn the economy around and you'll give us our money back plus more. So in that sense, QE is that equivalent of the government essentially issuing that paper, and who's the one buying? The central bank. Central bank can print a ton of money one month. They just print ink only because nobody think central bank can run out of money. It depends on which central bank. Like Zimbabwe one, you say, okay, I need to be paid 110%. USA, okay lah. In God we trust the US economy, and the US government will never go bankrupt one for now. You issue that, we buy in that sense. So QE is really just the government saying we need money to spend. Central bank says we buy, and then essentially put liquidity into the system through the government. So how well this one pan out obviously will depend a lot on the quality of the government that you borrow or you lend money to. So if the quality is perceived to be good, you continue to lend, or in the case of the US or the European Central Bank or the UK, they say, okay, these are the big developed nation, they will never go bust. We can continue to lend to them as long as they need the money, and also because we got more money. Let's say for now, we export more than we import. We still have surpluses. We need to put money to work. The Chenghu there is willing to lend at say 1% or 2%. Now it's 0% now. Okay, I buy a debt paper. So what we essentially seeing is this arrangement will go on as long as we believe that they can turn the economy around, and they will still be around to pay us because we lend them money for, let's say 1, 3 year, 5 year, 10 year, or 30 years, etc. So what we have got this time around is just that, let's say, unlimited QE.
Mm.
Coupled with super low interest, central bank says, I will just cut interest rate almost to zero for almost many countries, or even for some, negative. I charge you money to put money, if you put money with me. So unlimited QE just wait, hey, that money falling from the sky. Obviously, it's good, right? Okay, it's good. So that's obviously good from a standpoint of the financial markets. And from the broader economy is, if Cheng Ho is going to be like flooding the whole economy, Cheng Ho in this terms, I'm talking about the government as well as the central bank, essentially say, you know, we're basically guarantor of last resort. There, it's just keeping things going. Now, coming back, how long can we go on like this?
Yeah.
Obviously, you and I, maybe not in our lifetime, probably still okay lah. Our children not so sure lah. Especially when it comes down to the largest debtor in the world, the USA. So, which is why I suppose they're in such a hurry to still want to maintain global dominance. Because if people start to believe that, hey, the US economy is not as creative as it used to be, and is losing its status as a superpower, we don't want to lend to them unless it's very high interest rate. Or alternatively, you have other sources of investment which give you security, and go to sleep, return, and visibility and security. You switch. And in that case, US dollar starts to become less important in the world, then perhaps that is going to be an issue for the US going forward, because the debt to GDP is now government debt, federal government debt. I think it's running close to 200% of the GDP already. At this moment, nobody cares because the US will never go bankrupt because it is the USA. But the moment there is worry that, hey, how are they going to pay for all this money without printing largely more money or borrowing even more money that will never be able to pay back? Then obviously there's a risk. So this has been, I think, in and out of financial markets and discussion for a long time now. For now, it's just because the US continue to be the currency of trade is like 90%, whether of global trade. Even Bitcoin is priced in US dollars. It's now close to, I haven't looked today, maybe 30,000 already. I'm not sure how long it can continue to climb like this, but a weaker dollar will just mean Bitcoin continue to climb, or even gold for that matter. So it's very interesting. It's going to be academic discussion. You asked a very, I think, a pointed question and relevant question in terms of where it is going to go going forward. And in fact, this is one of the risks that will become more serious as we go. I don't think it will be a serious enough issue that will derail the financial market or the global recovery in 2021. But as we move on, it may become, because how the US is going to pay for the debt is a serious issue. If it cannot generate the productivity to make itself still the largest economy in the world, or the most important one. We're obviously seeing many reports about how the rise of China, rise of Asia, and how China is going to replace US as the largest economy. It's just a matter of time. It's whether it's by putting 1 year or we know that it's happening soon. And if that happens, does that mean that the US dollar will become less relevant? Does that mean that Chinese currency will become more relevant? I think all these questions are still being discussed about. Chinese currency use, I think the Chinese authority themselves also realize that they want to be able to maintain control over their own currencies. If they were to allow their currency too much to be used outside, they may lose the ability to influence, in that sense, the underlying value of their currency, just like the Japanese government. They have no control over the direction of the yen. They may do so on a daily basis for a short while, but the value of the yen is determined by the forex market of Tokyo, Singapore, Hong Kong, Europe, and in US, for instance.
So taking back from your analysis and your explanation in terms of this global economy, the QE impact, right? It's looking like the interest rate will stay low for the next year or next how many years?
Looks like it. I mean, at this point, we are looking at very uneven growth recovery rather than broad-based recovery. It is a very interesting new growth cycle that we are embarking on, in that there are still quite a few handful of sector industries that are still lagging and lagging well behind. We know where they are, you know, aviation travel, for instance. Some of the, Singapore, very small market, so we are really just depending on you and I to makan and help support our own businesses as foreigners are not able to come through. But for larger economy, they do have domestic demand that can cushion the impact somewhat. So stronger recovery. China, no need to say lah, they have even larger, and with technology and investment in digitalization, and they are running even faster together with the opportunity created by and the worry of, you know, implication of still the US-China relation not going to be improving anytime soon. They're racing in all areas, all sectors, to try to essentially regain control over their own destiny. So for us, what does that mean for inflation? Very interesting question. If you ask me today, I've certainly seen sign of inflation in many areas. Food, I don't know how many of our participants go to the supermarket and do their weekly grocery shopping, etc. You certainly would have seen, well, obviously we're not talking about pandemic period now. Seafood prices a bit more stable now, but meat prices, unless except with the exception of chicken or eggs at home, we're talking about probably 10% higher than before. Vegetable prices obviously depends on the weather. What we have seen globally is that commodity prices, less because of demand, but supply disruption, but weather has seen global, one of the index of food inflation, the IMF Food Commodity Index, is at a 6-year high. So that's at least, and today, some of you may be in logistics in terms of transportation, because our region here from China to Singapore is exporting more than importing. A lot of the containers are stuck in Europe and in North America because not enough boxes are coming back here. And together with port congestion, etc., in the American and the European ports, we're suddenly seeing port here facing, or logistic or traders facing with less freight, less container to put your barang in to send out. So freight charges has gone up sharply. So how this thing will play out in terms of food inflation in the coming months will be very interesting, except that because businesses are still wary on passing on costs, we may see many businesses taking it on, taking at the margin, their own margin, etc. But it's not all food. This is where it gets interesting, because I was again checking with friends and they were saying, this year, wow, there's so much abalone out there. I said, oh, okay, abalone prices are not going to be rising. In fact, it's cheaper. Mushroom, like, oh, okay, it costs more in terms of the mushroom side. So your Chinese New Year goodies, it will be very interesting to see how the prices pan out. But seriously, coming back to inflation, inflation needs, or inflation, people demanding more goods, willing to pay more for goods and service, obviously depend on how confident they are to willing to spend. In a case of like today, where demand is still recovering, but still somewhat weaker than, say, a year ago, I would say, broadly speaking, overall inflation, though food inflation may tick up, inflation on the services side may still be fairly muted. And food inflation, let's say Singapore, is only about 20% of our basket, will not be as significant as the services side. So overall, inflation is still likely to remain relatively mild, even as we go into the second half of the year, even with possibly higher food inflation coming through. But for us, obviously, you know, with the government support and some of the measures being tapered off, you know, your ERP charges likely, if the coming months are going to be better, get ready to pay a bit more for your ERP, for instance. So all these things will creep into cost of transaction, etc. So yes, inflation will tick up, but not enough, I would say, to worry policymakers to say that, I need to pull back more on the support, I need to tighten monetary policy. I think tightening our monetary policy won't be on the table, certainly at least for the most part of next year. Perhaps this time next year, if we are still not traveling, we can still talk about whether inflation will be a risk for 2022, but certainly less so for 21.
But then being said that, right, to conclude what you said just now, right, it looked like prices is going out, right?
Mildly. I mean, different
Mildly.
prices are even, you're talking about property market is a very different segment altogether. I mean, in Singapore, property prices obviously depending on whether people still believe that Singapore still have a future in the next 10, 50, 100 years or so. If so, our supply is only that much, one little island like this only. The only flip side is if we don't have enough people coming in, then our rental markets will be basically contained. But if we still continue to see steady number of people coming in because they're just more upbeat like me, and you know the demographic is going to be turning significantly or worsen significantly if we don't allow more. I mean, on average, we have about 100 births a day, a resident birth. Death is about 60 and climbing. So if we don't allow more inflows, that two line will meet and will be like Japan, where there are net more people dying every year than new addition to the economy. But Singapore is far too small. So for the property market, it is really about to what extent we continue to stay relevant for the world as a place to do business from and to work, etc. as well. If we do, then I would say the underlying support remains there firm. And again, in current environment, property market will be supported by a stable, say, job market has weakened, is weakest in 10 years, but not as weak as we had fear back in end of Q1 or beginning of Q2, primarily because of the so many measures being rolled out to support businesses and household. So that has helped. Super low interest rate has also helped. And obviously, in this kind of environment, when there is more positive outlook about a new growth cycle, there is that optimism that the property market has bottomed for this cycle. But Singapore isn't alone. Whether you're talking about Singapore, you're talking about even Hong Kong or even the US, Europe, even London, for instance, property market continue to be supported because it's just very, very supportive interest rate policy, liquidity, and an absence of alternative investment in this kind of environment, apart from just, let's say, the equity market side, or just for trading in, say, more exotic assets, such as alternative assets, crypto, for instance. So inflation will vary. Housing inflation, I think, will still relatively mild. It just will be more subdued because the underlying labor market condition is still somewhat soft, although confidence is there, and because underlying labor market is still soft, the overall aggregate inflation pressure, I think, will still remain relatively mild as well. But we need a little bit of inflation, because without inflation, there is no profit incentive. So we rather have some mild inflation rather than disinflation.
Okay, before we come to the later on, right, specific assets classes, which is let's say we have cash, there's inflation, how should we actually invest and where should we actually go to? We have another question that is I think in terms of global this global crisis, right? You see, in this global crisis, there is three possibilities. One is to make the rich suffer, or to make the poor suffer, or to make the government suffer. So looking at the current situation now is a lot of government, in order to mitigate the effect of COVID-19, actually many government actually force on the other hand is forced to actually provide economic rescue packages.
Correct.
Yeah, at
basically print money and, as I say, issue that paper to fund.
Support the so-called support the economy. Then in combination, right, of the losses in the output fall in the tax revenue, because they can't raise tax at this point of time also, and then increase in the fiscal expenditure exerting. So it could be a pressure to the public financials, right?
Correct. There is certainly one of the key worry. And the good thing, I suppose, again, is this, even before we enter this pandemic year, global debt has certainly been climbing.
Has went out so much, right?
Yeah,
Yeah.
has already been. So now we are adding lagi even more on top of that. For developing countries, certainly, as I say, the US, with many of the corporate, and certainly because of the almost free handout in almost all parts, many zombie companies are being kept afloat as well. So how will this all pan out? All these are the questions that will be answered in the coming year. Certainly, there's much discussion more on a more broader basis. Developing countries, emerging countries who don't have the resources are going to be seeing even more worse impact on many household and livelihood in terms of the impact of the pandemic on their economy. Let's say the economies of Indonesia, even India and the Philippines on remittances. Remittances collapsed significantly over, I think, easily a 6 to 8 months period. Gradually coming back now, but net we are still down for the year. These remittances are very important for the many families in the Philippines, Indonesia, for instance. What's going to happen at this juncture itself, we don't know. Government itself are piling on that. So this is where, for many of the multilateral agencies, there have been discussion of debt forgiveness in terms of making the terms, the repayment terms even more easier, because they know this is a risk, and a risk to a sustainable broad-based recovery. If the rich wealthy nation are the one who benefit, A, from the vaccine, B, from just the financial resources, it basically means that we have a two-tier recovery, which is going to be creating even more problem, A, at the social level, and B, in terms of broad-based sustainable recovery. So all these things are the question, I think, that will be tackled. How they will be tackled will be very interesting. But at least I suppose many agencies, whether you're talking about World Bank or the AEPP, recognize them on the problem and engaging government themselves to see how they can help, either with the healthcare problem on making sure the COVID situation remains controlled, or in terms of debt being contained. But at the private sector, private level itself, there are also many companies, zombie companies, who are being kept afloat. Because usually, I mean, to be brutally honest, a recession is a good reset because it takes away the froth, it takes away, those less efficient company, and allow new one to come in, we allow mergers, and then we have that reset that allows a quick recovery, which is why, in previous recession, let's say we come back to Singapore as an example, we go back to a pre-crisis level, it used to be 2 to 3 quarters. Now it may be more than year and a half to get back to that one. And if we were to allow zombie companies, more of them to persist, then it certainly means that you're starting on a new growth cycle with still inefficiency within the economy that allows, which may mean that the recovery may not be as robust, meaning that we may not get a full 10-year growth cycle, but we may still be subjected to a little mini crisis, and that obviously could undermine the quality of recovery, and obviously means that there are still risks, many more risks to the economic recovery.
Yes, so we understand that our government had prepared and pretty well in terms of planning, whether in terms of the fiscal, the money policies, or whether in terms of the debts controlling, right? So, but our silver one also pumped about 100 B, right, into the market. And what do you, a bit sensitive on this, what do you think that this so-called this support, right, will continue, and it is not going to continue the support, right? How the government is going to recover back this this investment, so-called this investment?
I suppose this is a necessary support to cushion the impact of the economy from a recession itself. The good thing, obviously, is we do have, a fairly deep pocket in terms of the savings from past reserve accumulated, reinvested, with a fairly good return. If there's any flip side from this pandemic, is that the financial market performance last year and this year have been spectacular. So for GIC and Temasek, for instance, despite a few obstacles here and there in terms of some of the listing not coming through, etc. as well, it still would be a very good year. In fact, it's a very good year for fund manager, big and small, or sovereign, even larger one like this. But these are odd years. Sometimes we have down years when you're in recession. But for the government of the day, I suppose it is pretty straightforward in that last year we roll out total 4 or 5 packages. We accumulated deficit, operating deficit of around 10-11% of GDP. Which is necessary. Going into 21, if we are saying that last year economy contracted 6%, this year we think we can rebound by say 4 to 6%, we at least will have some money coming through. As I said earlier on, there's no ERP collection for a while, there's hardly any land sales. So all these things will start to trickle through into the government coffer. But it will still be a case of very uneven recovery. So revenue collection will be better than the 2019 budget, 2020 budget, but it will still be well below what the historical norm will be. It will still be a case of government having to spend more than it collects. So it will still be a budget deficit in which the balance will have to be covered from investment return, from the accumulated surpluses and investment return should be, I think, quite consistent. So we may still end up with a little bit of a deficit, but it can be covered. And if need to, if by the time we present the budget in February, we still have very serious outbreak, despite rollout of vaccine around the world, we still have serious infection and serious restriction in place. We may, as I said, we may still dip into reserve to cover the balance. So Singapore is very unique in that sense. The current government may run the deficit, but it is sufficient it is a needed deficit to get on the recovery path. And then once the recovery comes through, we'll try to make it back. Because here for this, the government is very simple. Every term of government should live with a balanced budget. So the first half of the new term will be in deficit. Second term of the budget, second half of the current term of government probably will see surpluses as a result of recovery being more broad-based on the back of taxes. We are not going to be seeing GST anytime soon, but the moment we see broad-based sustainable recovery, and we are talking about earlier, say 2022, that's when you get ready. Something has to be given for something to be taken back.
Yes. So, okay.
So it's very straightforward. For other government, is less straightforward. It's still going to be a case. ASEAN region, for instance, all the government wants annual budget deficit. It is a case of them, let's say, for oil-rich countries, it is getting dividend from the oil company. It is about collecting more taxes from those companies who have done well, and ultimately issuing more debt paper, basically borrowing from the future for the present. So at least for a government and countries here, it's a very viable, I think, path forward, because this area is still on the growth trajectory. So borrowing from the future for today's use is still sustainable, primarily because we are in a growing, in a sense, a growing zone, and we are in the zone where it will continue to lead global growth. So that's a plus as far as Asian economies as we move on to a new growth cycle, driven by technology, driven by infrastructure investment, driven by a new rising middle class, where when we look beyond the pandemic, should see more broad-based recovery. But this, we are talking about at least 2022 and beyond.
So, okay, looking at the Singapore Excel, right? Singapore government most likely has stopped the support already, and
yeah, they can
but
take
then
off.
yeah should
Support
be
scheme, let's say for industries, you certainly can tell when aviation industries, planes are not going anywhere, support is still very much needed, whether it's Seletar Aerospace or whether it's Changi side. But within our F&B segment itself, it looks like we are on much more stable footing now. There are far more new F&B makan places that opened this year than closed. And so many of the support can be rolled back and in that sense be eliminated, because we cannot just spend because we don't have bottomless pit in that sense. So it will be very calibrated in terms of how many of these measures are and will be tapered off, whether it's debt moratorium or whether it is job support scheme. And some of the measures will obviously still need to be fine-tuned and rolled forward, because the industry still lags behind, well behind, as far as the recovery trajectory. So it's, in essence, we won't be spending as much in the coming budget as the 2020 budget, but government is still spending more than it collects. It will still be another year of budget deficit, although it will be and should be significantly smaller.
Then do you foresee there are more companies might not be able to tie to this slow recovery, and there is more unemployment rate going out? Will you foresee that?
Definitely. Yes, definitely. Double confirm on that side. The only thing is we see the worst of the deterioration, I think, behind us already. Companies are still shedding workers and likely to do so well into Q1 of next year. But I think the number will be far more smaller now. So the unemployment rate is close to peaking, although we think it will probably only peak sometime in the first half of next year before our base case. Let me very clearly state that our base case for our Singapore economy is the vaccine rollout and then more broad-based recovery and vaccine to keep global situation under control, etc. And second half, we'll see things being far more stable. And that's the base case of betterer second half with vaccine rollout. That's our 60% probability of base case for next year of about 6% growth. Therefore, on that basis, we think unemployment will peak. Let's say will peak probably around the middle of the year before we see improvement in the second half, as more private sector companies are more confident about hiring. Even, let's say, our embattled aviation industries may see some light at the end of the tunnel when we go to see broad-based recovery. I mean, it's as simple as looking at, say, Changi Airport, which on average handle about 1,000 flights a day, 500 landing, 500 takeoff, give or take. Currently, we're only talking about 200 flights a day, and usually these are not your typical, flying passenger flights these days. So this is where we are seeing. When will we see Singapore Singapore Airport handling 1,000 flights a day? I think we're still talking about maybe a couple of years' time in that sense. So again, calibrated approach in terms of targeting. So again, in terms of broad-based recovery, it will be similar in terms of some industry lagging behind. Same in terms of Singapore ports. Although we're seeing volume recovered already, but the number of vessels calling in Singapore I think is still 20% below the peak. Liners are just using larger container to save costs, and also because there are more large boats around as well. So there are actually fewer vessel calling in Singapore port, although the volume has recovered. So all these has an implication in terms of, say, the broad-based labor market and quality of the recovery. So unemployment rate set to deteriorate, but at a slower pace before we see more broad-based improvement the second half of 2021. On the base of we see the recovery panning out, as we said, of things rolling out globally, vaccine or China-US relation being more stable. There are no other sort of unexpected surprises from the geopolitical front as well.
Okay, that is specifically for Singapore, right? Because in terms of the preparation, in terms of the forward planning and strategies, our country in the world positioning, right? Our so-called our leader are pretty well prepared on that lah. But because again, Singapore is such a open economy in the world, probably the most open economy in the world.
It is.
The situation in our neighboring country, right,
looks challenging.
Looks threatening and
challenging. Again, I suppose the only thing for let's say the ASEAN. Now I put we used to be talking about ASEAN 5. Now we talk about ASEAN 6 because now we include Vietnam. Thanks to the US-China trade relation worsening, supply chain disruption and redistribution of supply chain, Vietnam certainly has seen a huge amount of investment, and it certainly has, in fact, it's the only ASEAN 6 country this year to register GDP growth. Wow, I think just under 3%, although Vietnam had been used to seeing 7+% growth in the previous 3 years. I suppose 2+% growth it can be considered a recession, but nonetheless, it is still growth. And I suppose if we look around, we would certainly be seeing political risks in some countries being more than the others. We have elections, say in the Philippines. Not this year, I think in the following year. Political situation remains fairly fluid. But I think the key underlying assumption must be, if we were to see economic growth coming through, then it is far easier for the politician to deal with the issue of the day. So very important, on the ground, we must see employment job growth coming through, even though we may be seeing some pressure on the political front. Because if you see jobs coming through, at least on the social side, there'll be less sort of complaint and worries and perhaps even law and order issue related to no work, no income for family, etc. But because if we were to see recovery coming through, in fact, I suppose we'll see for commodity-rich nations like Malaysia and Indonesia, despite what's happening in the political front, because the commodity cycle is supportive of jobs, especially an income in the rural sector, it actually helps the politician on the either side of Indonesia and Malaysia. So on aggregate, I will still say ASEAN region, ASEAN 6 in this case, really just ASEAN 6, will still be able to enjoy on the recovery path. Let's say on average, we see, say 5% contraction this year, maybe 5% growth next year. It will be more varied across the different countries. Vietnam may be far larger. I think I've seen some economists talking about 10% growth for Vietnam because of the lower base, or far larger for Malaysia, again because of the larger base. For Singapore, it can still be large, but I think there's still a lot of uncertainty around the true path of the recovery. So politically, if the economic condition is going to be less bad, ironically, or more favorably for politicians, it will be less of a problem for them and for Singapore too. Touch wood.
Okay, so looking at our neighboring country, right? North 3 like Malaysia, Indonesia, Philippines.
ASEAN 6.
ASEAN 6, right? Looking at the current situation and the way how they manage the crisis, the global economy, right? It might, right? I'm not too sure. I need a confirmation. It might have in the situation that the unemployment rate for this country will actually go out, the defaults or the even collapse in terms of aviations, in terms of the banks might actually go out also. How is it going to impact Singapore as a so-called central in this ASEAN 6?
Very important. I think there are, I suppose, reason to be cautious which is why you are seeing, I suppose, Thailand, where tourism is large chunk of the economy, trying, really trying to help their own businesses by opening. But obviously, like us, when we also try to open, new infections blow up. At least we are trying to lay out a procedure, a framework to still try to open, given, I suppose, our determination to be able to keep our local community cases under control. So for the other countries, as I say, the very big difference today is, even as cases in, let's say, neighboring countries stay high, life goes on for many. And only question for us is, do we open the border? To what extent the border restriction remains in place? But for the economies over there, because they are very resource rich and export remains fairly strong, they continue to generate jobs and
they can still sustain.
Can sustain. So and very importantly, you talk about business failure, etc. Again, as I say, ASEAN Central Bank, by and large, have managed to, I think, deleverage their economy from excessive borrowing. They are also mindful of a late stage growth cycle. Central Bank in Malaysia, Central Bank in the Philippines, all have been, I think, calibrating policies. So which is why we are less worried about systemic risk from the banking sector. NPL will climb up, but again, it's not to levels which are likely to trigger, say, significant worry on the credit rating side. Malaysia credit rating got lowered a bit, mainly because rating agencies are rightly worried about the state of government finances. But I suppose again is, if resource-rich countries like Indonesia and Malaysia can still have the palm oil and oil to generate through, it's kind of like a highly leveraged borrower, but still with income coming through on a sustained basis. And that's certainly where it has made a big difference for countries like Thailand, Malaysia, and Indonesia, with regard to, in a sense, recurrent income from the exports of agricultural produce and the agriculture-related processing industry as well. So in that sense, the ASEAN bloc by and large is far more luckier. The Philippines, very interesting though, they don't have the same kind of opportunity in terms of export side doing as well, but fingers crossed that they are still able to hang in there. So if of all the countries here, in terms of where the risk perhaps is more highest, I would say, but I would say Philippines, because they don't have as much opportunity on the export of product as much as the other ASEAN countries, who have the agriculture sector as a much more stronger contributor to their export side. Philippines much more narrower base. Yes, their larger base is only on the electronic side. So we really must have that side to get it going. So far it has been, and the other important side is we need the export, the external demand side to come through, the shipping side to come through, for instance, for the remittances flow to come through. Whether the foreign worker remittances, you're still talking about, the 2 to 3 billion every month. That has to pick up. If that can happen, then obviously the risk, let's say for Philippines, will be lesser. But these are some of the more country-specific risks for the Philippines.
Okay. Now we talk about the specific assets class. When we talk about specific assets class, we probably will cover equities, which is the stock markets, and the properties. These are the two key specific assets classes that most of our Singaporean money is actually parking at this area. So in terms of equity prices, we can see that, like just now I mentioned, right? Equity prices, it went down, and
Yeah, markets have done very well. Markets are, okay, this is where it gets very interesting in terms of last year, I'm still talking about this year. You know, after such a strong run for global equities, even Singapore, at the lowest point at the, I think, beginning of November, we were down like 25% STI. And we were second only to Thailand. Thailand was down by about 26%. We just don't have glove exporters or the healthcare side as much as some of the other countries have. The only reason why Malaysian market KYC has done well is almost single-handedly due to top glove, for instance. So where to go forward at this juncture? I think I'll just at this point just reiterate our house view in terms of if we step back and look at the condition. Things have turned out very well in 2020 because of the super low interest rate, because of the wall of liquidity, because of government support, just ensuring that the government and or regulatory and the agencies involved act as a lender of last resort, so that allows the confidence to remain in the financial markets. Are they going to be removed anytime soon? Doesn't look like it will. So if we roll forward to, I think I can say that with confidence over the next 3 months or so, is that A, you'll have still very supportive monetary policy, still very supportive fiscal policy, still in a sense very supportive news, say from the vaccine front, even though we may worry about infection cases today, we are still very supportive by a hope that US-China relation will not worsen. The new administration isn't going to be in a hurry to mend ties, although many American businesses and many of us would wish the new administration put that as a priority. That is not the Biden administration top priority now. It is about getting the pandemic under control, healthcare issue, etc. under control. So that might take most of their time. They're not going to be mucking around as much with the China-US relation just yet. Perhaps that will be a case, that will be a priority. Let me rephrase that. That may be more a Biden priority, perhaps in the second half of the year when the pandemic situation in the US is largely under control. So in that kind of environment, we can say that there's still a wall of money out there. Job losses, yes, has mounted, but most people are still gainfully employed, and the labor market condition isn't worsening as severely as before. Then it certainly would suggest that factors supporting, let's say, equity remains. The only question is, okay, do we, what are we going to be focusing on in terms of, will it still be tech? Are we going to be looking at growth industries because we are starting on a new growth cycle? Not quite the usual, I would say, path new growth cycle, because yes, many industries are on a new growth cycle, but there are some which are still, stuck in the downturn from the pandemic, and we know where they are coming from. The only question is, do you want to be early in getting, say, into the aviation industry, or the transportation, not the transportation, engineering, transport engineering sector? So all these things are questions. That obviously depends on one's own risk profile. Or you just say, continue on what we have taken our hope from end of this year. That is new growth cycle. The different sectors will continue to be on the uptrend, except obviously this time around you have new opportunities under the broad tech space as well, because technology has transformed our daily life, whether you're talking about trace together or even going now online for work or for leisure. And all these things have created opportunities, and there are many of these still coming through. And there are obviously many that continue to be in the pipeline, which is why you certainly may see or have seen government, whether it's in China, in the US, in Europe, taking a hard look at some of these very large tech companies because they suddenly worry about monopoly or oligopolistic behavior of these businesses. I mean, for you and I, we really only have one search engine, but there are others which are trying to make a difference as well. How do they get in and get a look in, for instance? All these things still shape up as opportunity. So in the space of, so to cut a long story short, from equity side, we will still stay invested, certainly in the next month or two. Typical profile, okay, let me just rewind. In a typical year, the best month are usually the last 2 months of the year, the beginning of the month. That's in November, December, January. For Singapore, the February month is usually we're off, and then we'll see sell in May and go away type, maybe what we see, and then the cycle, and then September, October, tends to be the 2 worst months of the year. I still stick to that profile, although it's a very broad generalization. But the fact still is there's still a ton of money out there, super low interest rate, and central bank and government continue to be very supportive. So that's still obviously okay from that side. So if we were to be on a new growth cycle, the only question obviously at this juncture is coming back to the other asset classes, including, let's say, commodity space. Commodity will, I think, likely to continue to do well this year. Fixed income side is going to be very choppy because there's still be the ongoing fear and hope of, yes, maybe there's hope of stronger growth. Interest rate may be tightened earlier, or maybe not, maybe yes, maybe not. So that constant ebb and flow will continue to be playing out, I think, in the fixed income space side. In the exchange rate, in the Forex segment, FX segment itself, we'll still say that because we are still saying that the base case is a new growth cycle, and the growth was certainly very much entrenched far more solidly here in Asia. Emerging market currency may get a bit of a lift up. Worries over the US may mean that the US currency may continue to stay weak for all the way into the first half of the year, and maybe the relationship being better, US dollar may recover in the second half. So that's the kind of profile in which, what does that mean for the Sing dollar? Maybe range bound to the US, we may see around that 130, 133 range for the most of this year. Upward bias should we see stronger recovery come through. If you start to see more planes coming through Changi, that means more likelihood of a stronger Sing dollar too. So coming back to the broader property, it will still be a case of to what extent we see the economic recovery become more entrenched regionally and locally, to what extent people continue to come through to Singapore to live and work and play. So if that becomes more entrenched, then obviously I think the Singapore growth cycle, property cycle, will be well supported. But will we see the kind of big strong acceleration in prices that we experienced in previous cycle? Not anymore, because essentially policymakers are wary of the damage of excessive speculation and run up in prices. So it will be far more stable, more indicative of underlying economic condition. If need to, then it may even tighten further rather than ease if prices were to run, they think, ahead of the fundamentals itself. There are no shortage on the supply side, I might add. But in terms of, but the flip side is because there's still so much money around, not just within Singapore itself, but coming in from outside. We're talking about families and businesses coming here using Singapore as a base. And we're not just talking about China, Hong Kong money coming here. We are even talking about the other ASEAN countries using Singapore as a base as well. And that continues to underpin property prices here. But obviously, behind that, there are many the different classes within the property segment as well. We're just at this moment just talking about residential. We haven't discussed office industrial, commercials, etc. So all these things may be shaped by how you and I live and work, how you and I, in terms of treat office, treat our home, and this will have impact on demand, office space, industrial space, etc. as well. But I think the bottom line here is, if the underlying economic condition remains stable, it should provide support for property prices. But you are not going to be seeing the kind of runaway property prices that we've seen from prior recession and recovery cycle, just because I think policymakers here have got a better handle in terms of how to manage excessive price speculation, especially in an environment where there is still much uncertainty about the actual true path of the economic recovery.
So we can say that for those that is waiting for the times that the market will collapse and then they can pick out discounted properties might not be happen.
I don't
in
think
this
so.
crisis, right?
The government policymaker isn't going to be seeing, because we provide a map to the economy and for businesses, for household, you haven't really seen, many businesses collapse. You may have seen many F&B joint close, new one coming through, but you haven't really seen banks saying we've got large distressed sales. That's not happening, not likely to happen, I think, at this point. Although the labor market condition remains soft, we do have that support. So that's very important difference. So just as we are not likely to see runaway prices going up, we're also not going to be seeing sharp collapse in prices as well. But obviously, it depends on projects. It depends also on developer or owners as well, to what extent they need to rejig their portfolios, etc. But unlikely to see significant deterioration in asset prices. But on the flip side, as I say, we're unlikely to see significant appreciation.
Mr. Song, your mic probably, your mic is not on.
Okay. All right.
Okay. So,
I'm not sure where I
looking,
lost you, but I would say, just to summarize that, really, we're unlikely to see a significant deterioration or a collapse in property prices in general, because we are not talking about a scenario where the recovery get derailed. There is still a risk, because at this juncture, our base case is 60% of 6% growth, say in 2021, on far more stronger recovery in the second half. But there is still that 5–10% things could still go wrong. So there is still that possibility of things not going as we forecast at this juncture itself. But a collapse in, or a sharp deterioration, or a sharp fall in property prices across the board is a small possibility only.
So looking at the property price is all-time high. There are plenty of money in the equity market, and then a lot of stocks might be overpriced also.
Yes.
And the gold, the silver, the precious stone, precious metals, right? And Bitcoins has been all-time high, has been going up also. Is there any investment advice to you actually, or any asset classes should we hold for 2021?
I suppose it's basically the same thing we've been saying in terms of we stay invested in all asset classes just to diversify the risk somewhat. Bitcoin crypto is something which I'm still not comfortable with, but because prices rising continue to suck in demand, and that continue to press prices higher, because again, like Bitcoin, there's only a very small incremental number of the supply every year. It's finite supply. It's not infinite supply. So if people still believe there is an alternative to fiat currency and Bitcoin seems to be there, it continues to be supported. It has no fundamental, except people believe that it's worth something. So enough people believe it's worth something, it suddenly is worth something, just a circular argument. So from the different asset classes, I would say again, it's because we are still, at the moment, as I say, we think 60% probability of 6% growth next year. So you still have, a high degree of uncertainty, a relatively high degree around the true path. So it's best to stay, in that sense, invested in terms of a diversified portfolio, whether it is within equity or whichever pot that you were to maintain for your own investment. So I would still say stay diversified. For the, let's say, I won't hold this for the next 1 year, although that's my 1 year time view. I will certainly review it again, let's say at the end of the Q1, to see whether the situation on the geopolitical front has changes, situation on the COVID front has changes, or is still panning out as usual. But certainly, for now, large wall of liquidity support still to suggest that you stay invested, say even within equities itself. Although, as you pointed out as well, prices essentially has priced in a blue sky scenario. All was well in like 2021. All risk has disappeared. It hasn't. Risk remain over there. So the only question now is, are market being too ambitious in pricing in the earnings recovery? To what extent that has already been priced in? And therefore, if already priced in, it means that maybe beyond the next 1 to 2 months, it may become more volatile and uncertain. If the impact of the current infection around the world start to also impact spending pattern and business activities as well. So things could still evolve even as we speak. So for now is take it as a 1 to 2 month view of staying invested, because again, as I said, January, February tends to be, January in particular, following on to a good December tends to be a fairly good year for markets. Whether you want to take an opportunity to take profit, also is worth considering. Take some money off the table because of 3 good months, and then reconsider re-entering things like this. Same with all markets. But certainly, there are opportunities, as I say, on the growth cycle itself.
Yeah. You're probably looking at the short term rather than long term, right?
It will be short term in this kind of current environment. Although I would say I take a 1 year view, I would constantly review that 1 year view given current condition.
Okay, thank you, Mr. Song. We start to take there are quite a number of questions from the audience.
Yeah,
so
sure.
can we start to take questions from them?
Yeah, anything, whatever you feel comfortable.
So the first question is from Wong Sun Wei, Miss Wong or Mr. Wong Sun Wei. He said inflation go out, right? And worse, right? He got cash. He got cash in bank. I think it's a good news. So what best choice, buying properties or stocks? So this is, I think, specific asset class that she is looking at.
Okay, again, as I say, I don't see inflation as a risk anytime this year. So the low interest rate, I think if you are comfortable with leaving cash with the financial institution, by all means, there is even an app that you can call on to see. Okay,
Mr. Song, less than 0.5.
Okay, now it's still, at least
0.5.
it's positive, German banks charge you money to keep money in the bank there. So obviously at this point, it really boils down to whether you want to just squeeze blood stone from there, or as digital banks and start to roll through and they start offering higher rates, there are also opportunity for you as well. Or you go to your insurance company and say, oh, I got this money here. Can I put money 5 years with you? They will give you better return for that 5 year itself. Or you essentially say, okay, you still have some money in the bank, and you start to look at the markets at this point. If you haven't bought, say, DBS at $20, will you be buying DBS at $25? I would be very careful. I would be very selective at this point, because if you haven't bought at $20, you shouldn't be buying at 25. So although there may still be some sense left inside there, just because after the new year they got money coming in, and fund managers still need to find money somewhere to put money to work somewhere. So you might just tag along with them, or do you just say, okay, I just go with, let's say, ETFs, exchange traded fund, in a sense, a no-brainer kind, and let other people do the work. I don't need the unit trust because they charge money on that. There are enough, say, exchange traded fund that you can tag along, whether it's global one, ASEAN one, gold one, everything, technology one, sustainable development one, some bit of that, for instance, and you say, okay, and or even commodity funds. So this is where again you have a sea of choices in terms of just something as simple for risk-adverse investor. Exchange traded fund gives you a whole suite of opportunity in asset classes which you don't directly have to participate in. If you are, let's say, not looking to invest in property. Property is going to be interesting. If you are looking to buy for to stay, I'd say don't worry. If you are buying to invest in, I would say be more careful, because again, if we don't see broad-based recovery, we are not going to see as many people coming into Singapore to rent your condos or your flat. So this is something you have to be mindful of in terms of the time frame. If you're looking at more years down the road, okay, that might be more doable. But even so, what we are seeing on the technology front is Singapore will be depending less on foreign workers than any time before. So our population growth may be quite flat over the near immediate for the next 10 years, because technology, innovation, and the use of digitization and clouds and all these things may basically mean that we may not have as many people living and working as before, or with the need, etc. as well. So there is something you have to be mindful of, in that the Singapore population of the next, say, 10 or even longer is not going to be the same as the past as well.
So the 10 years, 10 million, the 10 million
that's not going to happen.
target
You're more likely
not
to see Singapore population die out than we reach 10 million, honestly speaking.
So I think this COVID do change.
Yeah. The key difference really is that digitization, technology changes has started to replace the need. And obviously cloud, you can be different places. You don't have to be physically here. All these things are transforming ways of doing business. And you may not need as many bodies or person physically, say in Singapore, for instance. We are trying to, by creating as many opportunity for people to live and work in Singapore, by creating new opportunities, whether it is in sustainable development, or whether it is in terms of the pharmaceutical sector, or whether it is, you name it, in terms of how we're trying to encourage business setting foot here in Singapore in many of these new industries, or the two areas, modern manufacturing, modern services, will determine how large the population or how small the population will be. As I say, here, which demographic is very straightforward. The birth rate is about 100 a day. Death rate is 60 and climbing. So if we don't do something, it will cross. And forget about rental property because there's less people to rent to in that point. So we have to essentially get the birth rate up. That's not happening. So you need more bodies here. But the more bodies here now, in the future, maybe just in the past, you may need 10% to do the job of one. So you are now basically seeing a sharp reduction in the depending, in terms of the need for foreign workers.
Okay.
Even if you say our construction sector, 450,000, maybe that's all we need going forward, because we are using technology. We're essentially able to do the same or more with the same number of people.
True. Okay, so the next question is for SGCCTV, right? He asked, which are the growing market that we can venture into?
Markets to venture into, that's a very broad one. As I say,
actually, Mr. Song has shared something just now along the line.
Yeah, I suppose again, many modern manufacturing, modern services, basically is you can throw a dart in the ASEAN economies here, and there will be opportunities from big and small as well. And so this is a very exciting period in terms of while China-US relation continues to be, in a sense, a source of concern. At the same time, it creates opportunities as well. Brexit also create opportunities as well for us here in Asia, as barriers are put up between UK and Europe, physical barriers, because instead of there may not be tariff, but custom form and declaration audit to be done, all these things. So it creates opportunity as well. January, the New Zealand, Singapore digital trade deal will come into effect. That creates opportunity as well. So we are seeing many opportunities around the region, just because we are on a new growth cycle, except obviously the risk from the pandemic creates obviously uncertainty about, again, but yet at the same time, because of technology, innovation, digitalization, the whole space, ICT, all these things, this is where the delivery of goods and services using technology suddenly becomes a great opportunity in a region where we are going to be seeing government spending a lot more money on infrastructure, that connectivity. Interestingly, just as we are restricted from meeting, yet connectivity has improved significantly. So yes, opportunity across many areas. Very exciting to be young at this point.
Okay, next question for Valen. He said, Mr. Song, do you think the US stock market will continue to climb to new high in 2021? Any potential black swan event might trigger collapse of the market?
Yeah. Well, at least on the plus side, on the US side, we don't have President Donald Trump who will tweak and change market direction in a split second. Perhaps greater certainty, but again, is the big risk suddenly out there is the US market record high again on the back of stimulus, on the back of assumption that the US government, the US central bank will just continue to just provide all the supports, and it continue to lift everybody, including zombie companies, longer. And hence, the big risk obviously will be, I think just roughly, the US market is looking at around 20%, S&P 500, 22% growth in EPS for the coming year. If there's any risk of disappointment, obviously that will be it. So market has done well, not just in 2020, but also in 2019. Can it be 3 years in a row? So it depends on what kind of betting person you are. If you think they can be 3 in a row, go for it. If you are a bit more kiasu like me, I'll take some money off the table and wait. Primarily because it's difficult to continue a run, especially if there's still uncertainty out there. But there are opportunities still, and certainly in the tech space, we are also worried about government taking actions, many governments around the world taking actions on the antitrust front. So that could still play out. And for the US economic recovery, obviously much will really depend on the state of the domestic economy. Is the labor market going to improve significantly going forward? We are still talking about very elevated level of unemployment compared to what it was a year ago, even though it has been obviously lower on the peak when the pandemic hit and leading to widespread closure of businesses. We're not returning to that for the US, but for sustainable recovery and for the market to continue in the US to climb, that high level of joblessness has to consistently come down. It's stubbornly still high. So if it's not coming down on a sustained basis in the coming month, then I would argue that it will be difficult for the US market to repeat 2020 in 2021.
Okay. True enough.
Yeah, true.
So
a couple of things. Okay, share a couple of things that I look at for the US one. I will be looking, apart from the weekly claims figure, the other one I look at is what we call, I like to look at obviously high frequency data. So weekly claims is very relevant because it's more current. The other one is the Red Book. For those who can access to Bloomberg, etc., Red Book same-store sales, the weekly same-store sales. It was going at roughly, I simplify things, going at roughly around 5% year on year on a weekly basis before pandemic, and it tanked down, contraction obviously, say to about -2 to -5%. It has rebounded a little bit, but it's still somewhat choppy. Some weeks it is minus, some week it is +2. During sale week, it can jump up, but it is still below where it has fallen from in terms of recovery. If we want and so obviously the market has priced in this in terms of drop from 5% here to, and now it's recovered to here. It's important now going into 21, back for the 20, do we stay invested in the US side, is can this recover to the positive zone that it has fallen from? Hasn't. But for the US market to continue, not least weekly claim has to come down, but spending has to return back to the pre-crisis level. Is that happening? Obviously can only happen if people are confident about jobs and confident about money in pocket, whether it's from Uncle Sam government or whether it's from private sector being hired across a whole suite of industries, and many of which are still not hiring as aggressively as before. Okay, back to you again. Sorry, I digress.
Thank you. Thank you for a detailed explanation. It is so useful. I think it gives a lot of insights to whether investor or business owner that preparing for the upcoming year. Another question for Wilson Wong. He said if the QE is not stopping in future in major economics, stop. Right? How should it won't stop, right?
It will stop. It will take. Singapore is a good example in which businesses are doing better already. Do you still need to give them money? No need. So similarly, from a central bank standpoint, central bank is very straightforward in terms of if businesses are getting back on their feet, if businesses are hiring, they don't have to be lending as cheaply as before or dropping money from the sky, because obviously the economy doesn't need that kind of support. Because if they do, if the government is still as aggressive, private sector is still spending and hiring, what you end up doing is hyperinflation, because you've got so much money in the system that it will just cause inflation to spike. So which is why that's something to watch out for. But as I said, unlikely this year because we are not seeing broad-based recovery. But yes, that is an important consideration. And this is why one of the key important indicator we look forward to, apart from just hard data, whether jobless claim or the US Red Book same-store sales, it is the language of central bankers. They will be extremely careful in sending their message. if they start to feel a little bit uncomfortable about where they see uncomfortable, that is, economy is doing well already, they're starting to see people hiring more aggressively, paying more, they will change the tone of the language. They will certainly be warning businesses that we think cheap money is not going to be as cheap as before. So watching out for the languages of central bankers become another pastime to me, 2021. Not so soon yet. To me, it will be second half of 21, but it's important to watch what the US central banks have to say, Europe, UK, or even our own central bank here, whether we see our current exchange rate policy still relevant when the April monetary review comes through, whether they say, we're more confident, we don't have to run a zero appreciation exchange rate policy anymore, or we still are not confident enough, we still run this, things like this. So looking at our other thing, key things also to watch out for, besides the US-China relation, is the central bank, how they speak. Very important. That will give you a hint of whether they tighten, whether things like QE will set forever. It will not be forever. They will just basically say, government need less money, we need to lend less to government.
Okay, Wilson also asked, right? Let's say just now you actually answered about the QE, right? So QE will be stopping. So he asked if companies should actually keep the cash reserve. I think this is more like you got to look at the working capital, the financial management of your company itself, and whether let's say there is enough basics working capital in the company. If there is an excess fund, right, should he actually invest in gold or Bitcoin? Be one of the alternatives.
Oh, okay. I think very important with investment, it's always a case of you must be willing to risk a portion of it disappearing. Very important. You don't risk the whole pot. Then you're going to be, then you are entirely irresponsible. So it's obviously a case of what is the worst case scenario for me, and if that happened, am I still viable? Very important. I think that's really the key thing. Investment is really about making a bit more return. Investment is using surpluses to generate extra return. The rest is really about trying to protect by earning some money for the surpluses. So it should be a conservative portion that in the worst case you still have, and a little bit on a so-called the more aggressive side where you can risk losing without any damage to your business in general.
Very so don't show hand.
Yeah, so I
don't show hand.
Yeah, very important, very important. I mean, you don't have to look too far in terms of how Singapore manages its reserve. We have, I would say, more than $1 trillion in terms of our reserve accumulated over the last, say, 50 years, well, less than that, in our short history. But we don't risk them. We just put that amount. 1% of $1 trillion is still a ton of money, So rather than higher risk a portion, just be a more a certain portion that is going to be more investing in riskier assets, but the vast majority will still be in very conservative, very low. So even it is 0.1%, you say, okay, I take that, but there is a few dollars where you can risk losing for higher return. So that must always be the philosophy for investment.
That's very important.
Very important, okay, because the language today is very different from the past. Say, past as in before the last 10 years, because there are many events now that can trigger very sharp volatility in markets. And you don't want to be losing your pants and your shirt and your house at the same time. You can lose your pen and find a new pen tomorrow. Very important. Losing your house and without the pen, no fun. So, we have learned that. So because the growth, we can say, good. This year, start of, no, not this year, next year, start of a new growth cycle, opportunity. But yet, what has taught us is that the last 10 years or so, there are short swings within that new growth cycle. So those are risks. We don't know what could be the next black swan. We had put, President Trump trade war as one of the biggest risks to trigger a recession, but it turned out to be a very tiny virus. What could be the new? We don't know. It could be another crisis caused by global imbalances as global economy is dictated by large economy doing better because they got the money and the vaccine, and poorer country, indebted one, causing basically there is huge social instability globally as a result of income gap widening. Poverty gap as a result of pandemic is going to be significantly widened. Fortunately, in Singapore here, we are mindful of that, which is why we got so much transfer for the lower income family or the more vulnerable segment of the economy, such that, let's say, the simple measure of income equality, Gini coefficient, doesn't widen. In fact, I think it remains fairly stable this year because of the amount of transfer to the more vulnerable segment. But that's not happening in the rest of the world. So what could trigger? So these are some of the issues which potentially could trigger more bouts of market uncertainty and volatility in the new growth cycle. So it's always best to stay a portion significantly conservative, and then allowing one to be more actively managed to ride on the market ups and downs.
Okay, we already hit 5:30. Exceeded.
5:30 already.
Exceeded the time. So can we take now there is 2 more questions. Can we take all the questions and then we wrap up for the today's sections?
Again, I'm not going anywhere. I only go home only.
Great. Thank you, Mr. Song. You are so kind.
Right.
So Wilson have another question. He said, rise in GIG economy. Will commercial properties be going down?
Oh, gig economy, yeah. Okay.
Yeah.
Again, it's for Singapore. It is really all of Singapore is only that big. I exaggerate big. 700. I throw in the new Tuas spot, 730 square kilometer, and less than 6 million people, throwing all the baby and the cat and dog itself. So we need Singapore to stay relevant as a business center, place to a hub for all kinds of activities. But obviously, we have competition around. The only thing which we have is infrastructure, very well, political system, very stable, and a rule of law, all these things are the tick one, which is why you see families coming here, because at 3 o'clock in the morning they can still wander around the back street of Tanjong Pagar, and the parents are still saying, okay, you're safe to wander around. Not that many cities you can do that. So that has been one of the biggest, I think, attraction of Singapore. Can it still be? Will the digital agreement reinforces Singapore attractiveness? If so, how long? So these are all the very important questions that has to be answered. If the answer is still, Singapore is still relevant, say the next 10 years, okay, that underpin the Singapore market, so property market. But the other factor which is a big unknown is, because again is the aging demographic here, how many new foreigners will Singapore import to ensure the economy itself continue forward, and that also will be a factor towards the supply side, not towards underpinning the demand side as well. As I said earlier on, we won't be seeing as many as before. Obviously, new growth cycle means there will be some growth in foreign worker, because businesses will be aggressively hiring if we were to see broad-based recovery. But then, in the big scheme of things, it might just be a very stable kind of a market. So for rental, it might be more selective now, which is why, again, as I say, we are unlikely to see the same kind of return for investment in, say, residential property as before. And so this is where things are playing out. And depending on how the behavioral shift is panning out, is it permanent? You and I are working from home. Is office space still needed? To what extent, you know, the informal sector or the gig economy itself takes over? I think it's been fairly stable. Creates new opportunity that allows or that encourage more businesses to come and set up here, or will many offices, and somewhere I have seen, actually just this month, this week, two friends who used to be, two friends working in the Raffles area, their office have moved on to call sharing space. Make more sense because they are still doing, and they see split work office as permanent now. So all these have changed the landscape. But yet at the same time, when I talk to some people with officers, they say, okay, some of us are working from home. Now I'm making my office more conducive. I'm turning them into, like, you know, what used to be like Bloomberg offices. They have play area, they have coffee station. They need the same amount of space. But, you know, it's just that people are spread around and there are more fun areas. So I really don't know how the demand for office space, some have shrunk, some remain the same. So how they turn out remains to be seen. And yet at the same time, we have seen new businesses coming to Singapore, those in the modern service, modern manufacturing one, using Singapore as a base because of all the reason we have stated. So I really don't know. I would say there is still optimism that the demand for office space, let's say in the CBD area, is still relatively strong, but we haven't seen the kind of demand that probably will lead to the same kind of sharp increases in office rental, because they can be anywhere now, whether in Woodland and maybe even in Punggol Waterway. They're going to be seeing split and shift in office space. Do you need to be in Raffles Place? Probably not. Maybe for some they do. So again, coming back to same argument for residential, unlikely to see the same kind of rental price appreciation. Similarly, so perhaps for the office space, yes, there's demand for office space, but rentals may not be going up as much or as quickly as prior start of new growth cycle, just because of the significant structural shift we have seen in behavior as a business and a household. So you and I will be finding this out in the coming year or two as well.
Yeah. Okay. Now we come to almost the last questions. Alex asks, I think this one is basically is the financial questions. He asked why is it that US can print money unlimited and freely as compared to other countries? How does this work?
That's why Donald Trump thinks he's got more seriously. I suppose again, they are the largest superpower in the world, and because their currency is the dominant.
Their printing no need to back by gold one, right?
Literally, they can just print. It's, as people say, this is my grandfather wrote. This is my grandfather bank. So it's literally that at the moment, in that because US is so dominant politically, economically, they call the shot. So, which is why when we have extra money, like the Singapore government, when we invest, we also invest in US debt paper, because we don't have any. So after gold bar and this and that, after the currencies and debt, we end up still with US debt paper. So that's all government around the world. So how long can it continue? As long as the US currencies remains the dominant currency of trade. But obviously this will change over time, but I think not in my lifetime and not in your lifetime as well. So for now, they can continue to print. But people are starting to worry, which is why the value of the US dollar, if you look at this year, has declined because people are worried. But they're still not worried enough to say, hey, let me change this for, where can you change it? Bitcoin, but Bitcoin is also priced in dollar as well. So this is the in that sense, the conundrum for many is, if not US and US dollar, what's next? So that's the question that we want to ask as well. But for now, Taylor, I'm still printing left, right, and center, and still can get away with it. With my grandfather bank.
Okay, Mr. Song, we come to the end of the today's section.
Okay.
What is the final conclusion that you would like to give our business owners? I think a lot of our audience are business owners here, or individual investor in 2021 or 2022. What is summarize for this today's workshop that you would like to give to all of them?
Yeah, very simply it is, yes, 2021 has been an extremely brutal year. There is optimism for next year, but obviously there are still plenty of risks out there. So still, in a sense, stay careful, but there is room for optimism. I suppose something one can say in that, as I say, simply is, it's not all's well, but things are betterer, but be careful if there are, and won't be surprised if there are surprises. Be prepared for other surprises in an environment where the growth cycle, we are starting on a new growth cycle, but it is not your typical growth cycle. But don't be discouraged, because there are extremely large number of opportunities out there. For the younger ones, go forth and explore them. For old folks, I just sit back, relax, and drink my whiskey and see how things pan out over the coming year. Yes.
Sure. So
hopefully the year of the ox will see a few bulls charging around, but be careful of the swinging axe that might still catch a few horns.
Okay, so most likely the market should not crash. We should not see what had happened in Asian financial crisis or global financial crisis. It seems to it's the road to recovery.
Over the worst. Yes, we have gotten over the worst. But making money in 2021 for financial market may be more challenging. So basically, again, it's coming back using the US is 2019 good, 2020 was unexpectedly well because of money from, but can we repeat for 2021? I'm not, I'm a more risk averse person, so I'm not putting as much bet for 21 because we had already 2 good years. So, but there's still money to be made. We just need to be very sensible about it.
Thank you so much. Thank you so much for your insightful sharing for today's section.
My pleasure. I'm not going anywhere, so we can do
this. Thank you for your times, and then your insightful thoughts and sharings. You give us a lot of better understanding about the outlook for 2021 and what should we actually prepare for it, and in terms of our business, in terms of investment and our portfolio. Thank you so much, Mr. Song.
Thank you. Take care, everybody. Take care. Merry Christmas.
Thank you, everyone, for your participation also.
Happy New Year.
And belated Merry Christmas and Happy New Year. Wish all of you have a better year in 2021. Thank you. Thank you, Mr. Song.
Bye-bye.
Bye-bye.